Good evening, friends. Welcome to the webinar for Money Works for Me, the special subscriber webinar for Money Works for Me. Uh, I would just like your help. Could you please help me know whether you can hear me clearly? You can let me know about this through the chat window. है ना? Okay. Thank you, friends. Now we'll start with our special subscriber webinar. If in the course of the webinar, if you have any questions, please do let us know. If possible, I would take it. If not, we would get back to you through our customer care. So the first question is by Mr. Pawan. His question is, sorry, extreme sorry. Yeah, his question is, uh, can we buy Cadila Healthcare PTC India at these levels? So just let us have a look at Cadila Healthcare. Let us have a look at Cadila Healthcare. Let us have a look at the decision maker of Cadila Healthcare. Uh, Now, if we remember, Cadila Healthcare has just come out of its March quarter result. Prima facie for the year ended March, what we are seeing is that the performance has not been in line with our expectation. Uh, it is among the few companies that is likely to be negatively impacted because of the new drug policy, new drug price control order that is coming into effect. And we believe this has been largely been responsible because of which the stock price have been bit weak to speak about. Uh, Currently, we are in the process of reviewing our guidance for Cadila Healthcare. We would like to assess what the impact would be because of the new this drug price policy. So as of now, I would suggest that let us not go put our money into Cadila Healthcare. It is just at a substantial difference from the MRP, but let us go and reassess what the impact would be of the new drug price on the Cadilla's market price, on the Cadilla's MRP. Once we are clear with it, I think we can then see whether it makes sense for us to buy Cadilla or not. So for now, I would ask you to just hold your horses as far as Cadilla is concerned. As far as PTC is concerned, if you see our 10-year X-ray itself shows this as if the company is not a very good company. The performance of the company has not been very good. Just let us have a look at its 10-year X-ray. If you see the large reason because of which we believe that PTC has is not a good company to invest into is because of the red value creation index. As you may be aware, we have started created this new index which measures whether a company is creating value for its shareholders or not. Uh, Now, if we see PTC over last 4 5 years has not been creating any substantial value for its investors, and because of this big reason, we are of the opinion that let us not invest into PTC as of now. Probably it may be a story over a much longer term, but as of now, it might not make sense to enter into. We may see once the fundamentals of the company are improved a bit, probably then it may make a good sense for us. As of now, it does not make good sense given the fact that it is just slightly above our DP also. I would rather suggest that let us wait for it. Once the fundamentals have improved a bit, probably then we can think about buying into PTC. The next question is by Mr. Lal Modi. How can I invest in Nifty 50 index only? If so, then what return can I get by 2020? Can I be choosy among Nifty 50? Uh, Mr. Modi, it's a very good question. Uh, Over last few years, there have been some mutual funds which are also called as exchange traded funds. If you were to buy these exchange traded funds, these are just like plain mutual funds, then you have exposure your exposure to Nifty is 100%, as in the exchange traded fund will ensure that the percentage within the percentage of shares of, let's say, Reliance would be closely matched with what it is in Nifty also. So you can take an exchange traded fund which has Nifty as a benchmark index. So that would give you 100 full exposure to Nifty as such. Can you be a bit choosy about buying into certain specific companies? Yes, our back-tested result shows that being choosy about some companies definitely has its own benefit. We, if let's have a look at say our top one of our plans, that is top 50. Top 50 superstars, as you know, is closely modeled across how the Nifty itself is valued at. Now you can be choosy by two ways. One is you can buy into only green and orange company and avoid red companies like say DLF or JP Associates, which are also part of Nifty, or BPCL, which is also part of Nifty. Secondly, if you are looking at creating a long-term investment portfolio for yourself, which is primarily drawn from Nifty, then you can also switch, pick and choose. As in, let's say we can look at Kane as of now. We can, but we would wait for Cipla to some extent, and we will wait for Coal India to some extent. Uh, but yeah, once the company is near its DP, or substantially at a very good discount to its MRP, let's say if you have a bit more higher risk, you may even consider say Gale as of now, even though it's not very close to DP. It's bit close to DP, not still above DP. You can still consider Gale. So by picking and choosing such type of companies whenever they are available at a substantial discount to the MRP, yeah, we can pick and choose from the Nifty itself, and that should give you much better returns over a longer term than what you are getting as of now. Speaking about your other implicit question, that what return you should expect over 2020, it is, I would take you through two scenarios, and depending on what scenario will play out, probably one or the other return is something that we should expect. Now, if you see globally, the central banks have resorted to money printing. Typically, whenever this has happened historically, over lots of ages, whenever a government goes on a money binge, we see that the prices of the real assets tends to increase a lot, and this directly ends up impacting certain types of industries. So in this kind of scenario, you would see that real asset oriented industries, that is commodity industries, asset oriented industries, would tend to do well, because the underlying commodity itself is going to become expensive. So under this kind of hyperinflation scenario, these kind of stocks would end up doing better. On the other hand, we are also seeing that it has been already been 5 years, but while the stock markets have done well over the last 5 years, the economy has not done well either. When I say Indian economy, or even when I say the global economy, both of them have not done well. So when I look at that, my what I would like to point out is that the second scenario is that probably, and we are entering into a new phase wherein we need to forget a period wherein we were seeing a very high growth phase period, when we were seeing that there were some countries that were growing at 10-15 percentage rates, certain large countries growing at 10 to 15 percentage rates, or certain medium sized countries like India growing at an 7 to 9% rate, and expecting to go at a much more higher rate. In this kind of companies, in this kind of economic scenarios, what we typically see historically that has happened is that companies with real competitive advantage have done well. So based on both of the possibility that these two can play, what I would suggest is to have a portfolio that is in a bit of that has about 35 to 40% exposure to defensive sector, but at the same time has 50 to 60% exposure to companies who are into real estate, but also have very strong balance sheets. So you can look at Coal India, you can look at NMDC, you can look at GAIL India, the, Grasim. These are all companies who deal in real estate, but they have very strong balance sheet. These kind of companies would actually end up doing extremely well compared to, let's say, Tata Steel or Hindalco, which, even though they are also into asset business like steel and aluminum, but their balance sheets are too stressed. Even if they future in the future there were to be some opportunities, now the balance sheet does not have the capacity to take on or capture those opportunities. So if you were to play it that way, and I am supposing that by 2020 many of the large companies will be one of these companies, then we can substantially expect that we should get over the next 10 years about 14 to 15% on an average return. There will be some downtimes, there will be some high times, but yes, on that rate is what I would be looking at. Having said that, I would just like to caution all my investors. Generally speaking, what we are seeing is that uh, every time the Nifty is reaching somewhere near to 6,100 to 6,200, it is trying. It becomes very hard to justify the valuations given the results that we have seen. We need to see extremely good results before we can really say that the valuations are also looking cheap. The only thing that can take Nifty upwards is only the fact that the three major central banks, one US, second European Central Bank, and third Japanese Central Bank, are all printing money. So that, because of that creating excess liquidity, we can see another few points of upside, about 5 to 10% upside. But on the other side, there is a good risk of a big downside, and I would like to caution you on that side. So keep a substantial, at least 10 to 15 percentage of your portfolio in cash, even if you would have an opinion otherwise, that the economy may do extremely well, that the stock markets may do extremely well. Request you to just have 10 to 15 percentage of your portfolio in cash, so that we can take a benefit of any event because of which the prices may were to correct drastically by 15-20 percentage. The next question is by Mr. Shivraman Eshwaran. Uh, yeah, his question is that he went by our advice on BHL. They are not doing well. How to avoid this in future? Uh, Mr. Ishwaran, I understand what your pain point is. Now, I would like to clarify on this, and I will also like to tell you a few solutions that we have planned on this. Now, if you look at some companies like BHEL, EIL, NMDC, these are all cyclical oriented companies. They go through a business cycles. Unlike, say, Infosys or TCS or even HUL, these are not the companies who have a very linear sort of earning growth model also. So if you see how a company moves from a cyclical company reports its profits from a when it moves from an extremely weak cycle to a strong cycle, you see a very large profit growth. As in, from a weak cycle to a large to a extremely profitable cycle, you will see about 100%, 60% profit growth. This large growth happens largely because in the weak cycle their profits also go decrease a lot, and this is what we have seen in many of the cyclical companies. So in order to identify these kind of companies for our investors easily, and so that they can set their expectations right, what we are now going to do is, over next 1 to 2 weeks, against each company there will be a postage stamp like symbol which would identify it within one of the six types. I'll quickly go through those six types. One is cyclical. Second is stalwarts. Stalwarts are typically companies like your Asian Paints and TCS, who grow at a decent rate, not a very high rate, but a very decent rate. Uh, when I say about this rate, I am speaking about their business performance, or not necessarily specifically about their stock performance. Uh, Third is your growth companies. Growth companies are companies who are not paying probably too much of dividend as of now, but they are using majority of their profit to increase their revenues in the future by building more assets, building by acquiring more companies. So in this kind of companies, these are called as growth companies. They would grow at a substantially much more higher pace than the rest of the peers or rest of the economy as such. Uh, and fourth is your value companies, companies which are trading at a very big discount to what their asset value itself is. And fifth is the turnaround companies. Uh, companies who have gone through a very past traumatic history but now are expected to do well. And the last one is laggards. Laggards are companies that are not doing well, have not done well in the past, are unlikely to do well in the future too. So these are companies that we would like to avoid. The reason to do this type of segregation is that we would like to set expectations right. Like for a average risk averse investor, probably putting in a, let's say, total of 15-20 percentage of its portfolio into a cyclical sector may make a good sense, but going beyond that might not make a really good sense. It may and actually put too much of risk in his portfolio compared to what he would like to see in it. So we are trying to do that segregation and identify those companies for you. Once those are done, what I would like you to suggest you is to go through our risk analysis framework, see what your risk perception is, what your real risk is, and then have a portfolio design in such a way that you do not you if you have high risk averse, then let us have a large amount of cyclicals. But if you have less risk averse, let us not have a large amount of cyclical. Speaking about BHL specifically, BHL is a very long term story. For BHL to really kick in, start making a good amount of money for the investors, it would need that the power sector itself start doing well. Now, some of the reforms have already starting taking place. The SEB loans have been reformed. They have been restructured. Sorry. And also what we are looking at is that over last 1 or 2 months, even the CERC has come up with certain policy notes which mandate that effectively Indian companies will enjoy a fuel plus pricing. What I mean is, if the fuel prices were to increase, they can pass on the cost to the customers, but if the fuel prices were to decrease, they would also have to pass on the benefit to the customers. So that substantially de-risks the power sector business model as such. And we believe that once the new government comes in and they start taking other few actions, especially on the land reform side, we'll really see a kick in the investment cycle as far as power sector is considered. And once that happens, BHL should do extremely well. Speaking about BHL, one question that you would have in your mind is the pricing right? As in, is this the right price to buy BHL into? We believe that 199 to 200 is a very attractive price. Is it something attractive with it such that you would get a very good return within a year? Probably not. But is it a price very attractive that you would get a very extremely good return over next 3 to 4 years? Extremely yes. At 200, BHL is at a very big discount to what its even historical valuation has been, and we believe that market has been very short-sighted. Over next 2 to 3 years, any person who is buying into BHL as of now should do extremely well. Its balance sheet is very unstressed compared to its peers like L&T. Uh, and that is what we like very much about BHL. We think BHL should do extremely well over next 3 to 4 years. Might not do as well over next 1 year or so. The next question is by Mr. Ramamurthy. His question is about prospects of Tata Steel and Hindalco. Uh, Mr. Ramamurthy, the first thing that I would like you to point about both Tata Steel and Hindalco. Let's have a look at Hindalco as such. Uh, if you see at Hindalco, we have rated it as red, and recently we also had changed its guidance. Also, we had a long-term prospect as good, but we have decreased it to somewhat good. And I would like to clarify why. I think let us go through when looking at its 10-year X-ray. See, in sometime around 2006, 2007, they took a company called as Novelis. Now, when they took the company called Novelis, uh, they had taken the company at a substantial uh, ex- they had taken this company at a substantial debt on their balance sheet, and that is reflected by our debt to net profit margin. Because of this, if you see, the value creation index has been extremely negative for Hindalco, and this is one big reason why we say Hindalco as of now is not a very good investment criteria, especially for retail investors. Is it a case for a turnaround story? Probably yes, it may become a turnaround story, but there are few markers I would look out for. One basic being the aluminum prices globally have been falling. I would expect that to stabilize a bit and start recovering. To put a fact out to you, about 50% of global aluminum companies are not making money even on the cost of their goods. So basically they are not even making operating profit. That is a very very bad scenario, and because of that reason I would like to be a bit cautious, largely been because it is a very highly overstressed balance sheet. The balance sheet would not have been stressed as it is for some other metal sector companies like say SAIL or NMDC. I would have been not that cautious, but because of the fact that the Hindalco has a very stressed balance sheet, I would like to be extremely cautious. If a similar case also works out with an Tata Steel, to if you look at Tata Steel, things have somewhat not that good with Tata Steel. Their recent operating results have been good, but there is a structural problem in the Tata Steel itself. Tata Steel's major revenues as of today come from Europe, and Europe itself is not going through a very good scenario. And we do not foresee that Europe would recover from its economic problems anytime soon. Given this, we do not see that Tata Steel Chorus would do substantially well over next 1.5 year. And while if you see the revenue growth has been very strong, and when you say profit, the profit, while it looks strong, I would recommend anyone who is reading Tata Steel's quarterly numbers or an annual numbers. There is always a mention made by auditor, and he flags it off by saying that if the and that has to do with the pension and losses that Tata Steel typically takes it directly to its balance sheet and not through its profit and loss, because of which its losses looks much lesser than what it actually is seeing. uh, this is one big reason because of which I'm not very comfortable with Tata Steel as a company. Again, if you see Tata Steel, the value creation metrics has not been very good. The debt to net profit looks very extremely very high, and if you were to see other stable measures like debt to equity, that also is on a very high side. So yeah, just like Hindalco, Tata Steel can also be a case for say a turnaround story, but I don't think that the time has come now. Mr. Cyrus Mistry, the new chairman for Tata Steel, has his work cut out. We would like to see what his plan is to de-risk the business model, how he plans to take substantially decrease the debt level that is on Tata Steel books. Once that happens, probably we can relook at Tata Steel a bit differently. But as of now, I would suggest that let us stay away from Tata Steel and Hindalco for now. Both have the same problems. Targets for NMDC Syntax for 2 years, buy and sell signals, not much. Sorry, I'm extremely sorry. The next question is by Mr. Ravindra Kumar. His question is, what are the targets for NMDC and Syntax for 2 years? Uh, okay, and he has a feedback by us to us that buy and sell signals not much reliable and need some huge improvement in that area. Sir, your feedback is well taken, and I would like to point out to you that we are really working on getting that buy and sell signals right. At times, you need to understand that we might not get everything right, and in those times, we would be putting out analyst notes. And if you have bought into a company at a buy price and it has not worked out for it, please put out a question on what is the reason. And if there is a it is a short term pain reason, then probably it's something that we can live with. But if it some fundamental change itself has happened place, then probably we should really look at booking our losses and getting out. Speaking about NMDC, uh, NMDC is a extremely good buy, and I would put it in a very practical simple ways that even we common folks can understand it. Now, if we look at NMDC as it is today, let me if you place this latest financials, you will see the market cap of NMDC. Uh, the market cap of NMDC is about 47,000 crores. Now, out of 47,000 crores, what I really like about NMDC is that NMDC has about 21,000 crores simply in cash. 21,000 is in cash, and that is translates to about 65 to 67 rupees per share is in cash. and the rest is just for the operating business. Now, if I see that way, then NMDC is substantially very low, has a very uh, undervalued stock compared to even its global peers. Typically, most global peers trade at price to equity PE ratio of say 10 to 20. NMDC trades at a price to equity ratio of around 7. And if I were to adjust it for the fact that it has about 20,000 crores as in a cash, then actual price to equity is much more less as 3 or 3.5 also. And this is for a company that is sitting on a very large asset, iron ore asset. It has just been hammered for the fact that iron ore prices have been have weak over last May. What most of the market participants tend to forget is that unlike most of the global companies, NMDC actually has been selling over last 3 4 years its iron ore at a substantial discount to the global market price. And since last year, when the Supreme Court has mandated NMDC to sell iron ore only through e-auctions, we are seeing that this discount is slowly and slowly collapsing. Meaning, while the overall iron ore market is falling, NMDC is either keeping its iron ore prices stable or is slightly increasing it if when we see at a over 4 5 months period. So when I see it that way, uh, I do not see that NMDC should do really bad. Another thing to look out for is NMDC actual cost of operations are much lower than even the largest of the large iron ore operators, and that's why I don't foresee NMDC to make any losses in future. So that way, when I see NMDC should is a extremely well buy. Will it be what would be its price target for 2 years? As such, we are not in the we do not give a price target as such. But what we believe is that if China were to stabilize a bit, we believe that our MRP holds, and that MRP can be taken as a good indication of the what target we are looking at for NMDC. What I would like to point out is that, having said that, yes, there can be a 10 to 15% more negative correction over here, largely because of driven by market sentiments been negative towards NMDC, towards and over the all economy as such, largely driven by China getting slowed down and iron ore prices getting hammered as such. So I would suggest that you can start partial buying it, but try and see to it that your if your NMDC is weak, then your average price is somewhere in between 117 to 95 rupees or so. That should hold well. As far as Syntex is concerned, I would avoid telling you to buy into Syntex, largely because Syntex is seeing a very stressed balance sheet. Bare minimum, I would expect that let the new government come in. Major part of those balance sheet stress in the Syntex is largely because of the cash he is yet to receive from the government because of the Jawaharlal or Indira Awas Yojana, in which his cash has a large portion of his balance sheet has been attached. So once a new government comes in, we believe that a situation for Syntex would also improve. I would probably wait for the election, and once the election take place and we have a stable government, a good policy on the fiscal deficit side, that would be sometime when I would see an initiating position on Syntex. Uh, this may mean that I would lose out some 10 to 15 percentage on Syntex on the as such, but I would rather be cautious because at the end of the day, it also has very high debt levels. Uh, The next question is by Mr. Surveyor, Mr. Mankek Surveyor. Do you give weightage to companies who reward shareholders with good dividends? What would you term a good dividend? Yeah, if a company is a company that regularly shares whatever value it creates for its shareholders with the shareholders, yes, we do reward them. Typically, these kind of companies will have very low cost of equity. Let us have a look at a company. Let us look at, let's say, ITC, for example. ITC has done really well. I would like to point out how we end up rewarding. If we go to price calculator, you will see that there is something called the expected rate of return. This is at a 10. This is very low. This is it is low because of the fact that ITC is one of pays out very good dividend levels, while he's also going through a growth phase, but he also pays out a very good dividend level. Well, the management has a history of sharing the value created with its investor. If you were to use a price calculator, and let's say hypothetically, let us say that, let's say ITC was not a good company. Let us say they were not to share their money with the investors, and I were to in a bit circumstance, I would. So what would have been the valuation, assuming just I were to change the expected rate of return, then it would have come out a very low, extremely low number. I think I've made a mistake. Uh, I put the P. I've forgotten to put the P. Let me put the P. Yeah, 24. Now, if you were to look, the value would have come to be much more lower. So this difference, if you see in between, when I had an expected rate of return, also called as cost of equity, at 10 and 15, if you see, is about an 80, about 70, 63 rupees, 66 rupees or so. So if you see that 66 rupees benefit that we give to ITC is largely because of it being a good value creator. What we consider a good dividend level, this is a bit much more tougher question to answer, largely because each and every company is in a different phase of growth. So for example, if Bharti were to pay out a dividend, I would say that I would end up punishing Bharti. Why is it so? Because Bharti is in a phase wherein he needs to pump in whatever money he is earning back into his business so that he can buy new spectrum, he can buy assets in new geographies, he can expand his company. Excuse me. He can really bring in new technologies, new value added services for his customers. So if Bharti were to pay out a dividend, it would be a very big negative. On the other hand, if HUL were to pay out very low dividend, I would be extremely negative again, because HUL has reached a phase wherein it has become a very big matured company. If you were to just even look at some of the basic ads of HUL, let's say if we were to look at Fair and Lovely ad, this is one example that I quote very frequently. But 4 to 5 years back, if you were to look at Fair and Lovely ad, you would see two girls. One of the girl was using a Fair and Lovely, the other girl was not using a Fair and Lovely. What is the implicit message that HUL is trying to give it? Is that while HUL has a market share, there are some people who do not use Fair and Lovely. They are not, and there is still some amount of market share still to be captured by HUL. But if you now look at what Fair and Lovely ads are, both the girls are using Fair and Lovely. One girl uses more frequently, the other girl does not use it so frequently. This is largely because if you see at HUL in major of its product portfolio, it has become a huge giant. And for HUL to really grow, it is not that the HUL product has to now grow; it has the market itself has to grow, because only then it can grow substantially, just largely because of the sites that it has in each and every one of its product categories. And because of that reason, we actually does not need too much of cash to build its future growth. And if HUL were to pay a very low amount of dividend, then I would be very negative. So what is a good dividend depends extremely on uh, what and a stage it is in. If you were to look at Opto Circuits, one of the big red flags for Opto Circuits always would have been that this is a company that goes out and each year does an acquisition, but yet it is paying a dividend. Now it is not earning a cash flow from operations such that it can finance both from its profit itself, that is the acquisition, as well as the dividend. What it used to do was, in order to pay out dividend and in order to do acquisition, it also used to go out and borrow money. Now this kind of a company, I would be extremely circumspect if it gives out dividend, because if you need money for growth, don't pay out dividend. If you don't need money for growth, then pay out dividend. This is how I would look at, and how would I analyze. The next question is by Mr. Paresh Maru. His question is that he has portfolio stocks which have suffered some losses. He needs advice on mobile global, Jubilant Food, VSC Dealers, and PC Jewelers. Uh, on I would like to point out that Mr. Maru, firstly, in most of the companies you should have never invested into. We also have not suggested it. Just let us look at on mobile. What we do not like about on mobile global is that while the company has pursued growth, uh, and if you see the revenues has been growing well, even it had just had one bad year if I were to say on a profit basis. But if I had to look at its value creation, the value creation has been very pathetic for a IT telecom oriented company. Its value creation has been very negative, and that is one reason I would recommend that unless there is some short term upside to the company, probably it is something that we need to get out of as of now. Probably we can do this offline someday. We can look into whether there is some upside for on mobile, and if it is so, we can be there. Otherwise, we can really think of exiting and booking our losses. The other company is PC Jewelers. Now, if you look at PC Jewelers, unlike on mobile, PC Jewelers has shown consistent value creation through 2010. Uh, those the sales growth has come in largely because of the it been a very small base rather than its larger peers. Uh, we are seeing that the cash flow has become a bit negative, and that is one big negative for PC Jewelers, but not that big a negative. I rather suppose that a large correction in PC Jewelers share price, which may have happened recently, may largely be to do with respect to gold prices themselves correcting. I think let us have a look at PC Jewelers chart itself. That should give us a good indicator. Yeah. So I have my chart for PC Jewelers. Okay, sorry. It has only 1 year of reported earnings, consolidated earnings. Okay. So if I were to look at PC Jeweler, if you were to see, give me a second. Uh, uh, if you were to see, a large correction has happened largely when gold itself has been weak. Uh, I suppose PC Jewelers, because of it being in a good value creator in the past, I think we PC Jeweler is something that we can still look into, uh, keeping into our portfolio. Even though I suppose you would have bought sometime in the IPO pricing, and now it is somewhere just below it. Uh, I think PC Jeweler is something that we can continue keeping within our portfolio. It may it has fallen down a bit, but I think we can keep PC Jewelers for now. Let us see how it does in its March results, and that would give us a very good indicator whether we should exit or we should continue. Its cash flow has been strained over last 1 or 2 year, but let us see whether how things look in this particular year. If things look good in this particular year, I think PC Jeweler is something that we can continue keeping within our portfolio. Uh, the next question is by Mr. Vinayak Mangaokar. His question is, uh, what would be estimated return on L&T, M&M, Ranbaxy on 5 year basis? Which sector will be uh, best for investment on 5 year horizon? Uh, Mr. Vinayak, my answer to this would be I do not like L&T as a company. It may be a bit of a bias, but I would lay out my reasoning for it. Let's have a look at L&T as a company. Now, if you were to look at L&T as a company, now over last 4 or 5 years, company seems to have made a huge amount of money. Since if you were to look, especially from 2008 to 2012, uh, if I'm not wrong, let me just have a look at its net profit margins. See, if you see its net profit margins has been somewhere around 7 to 8% each year, and it has been clocking a sales of about in between 29,000 to 64,000. Meaning over the last 5 6 years, he would have taken home about profit. Sum total would be about say 20,000 crores or so, plus or minus 5 10%. But if you see at the cash flow numbers, the cash flow numbers are extremely negative. Its balance sheet is very stressed. Excuse me. Largely because of the large debt he has taken on its books, and the value creation matrix has been very negative. For one big thing that I would like to look into L&T is that the cash flow become very high positive number before I start making investment into L&T. Otherwise, L&T is a story wherein the balance L&T would enter into many of the business which I do not know whether they really have capability to execute the business well, gain a competitive advantage in this business. Like I'm very worried when L&T enters into a business like insurance, business like AMC. Does L&T really have competitive advantage over the big financial companies? I am not very sure. Again, L&T has become a huge monolith in which it has entered into a businesses in which it has really little understanding or ability of how to run those businesses. And because of these reasons, I'm been negative on how L&T is expected to do into the future also. The fact that its cash flows are negative are big red flag for me, and I would suggest that most of the retail investors should avoid companies in which the cash flows is negative, and the large reason is because of the investment that the company has to regularly make into its working capital, because of which the cash flow becomes negative. If it would have been because it gets substantial amount of its income from its investments, like it is in the case of say Reliance, or even in sometimes in case of a state PSU company like NMDC or so, in which because they have huge cash balance with on their balance sheet, they also earn a huge amount of money as interest when they keep that money in the banks and a fixed deposit or in a bank within bank deposits. So unless that is the case, I would avoid a company in which the cash flow operations is a very large negative number and have consistently been so for a very long time. I would really avoid such kind of companies. The other question is, we like M&M as such. Among the auto companies in the four-wheeler segment, we believe M&M has really a good chance. It has developed a good product portfolio in SUV industry. Just excuse me for a moment. So we really like M&M. M&M is something that if you were to find somewhere even just below our MRP, about let's say let's have it look at its decision maker, that would give us a good indicator. Yeah. Now, as of now, M&M is a bit over its MRP. But if let's say if we are to correct under some market correction factor, and if it to even come down in between my MRP and DP, let's say somewhere around 700 or so, I would suggest that yeah, probably M&M can be a company that can be thought about for as a investment. But as of now, because it is above $100 above my MRP or 16% above my MRP, I would be a bit wary of when I putting my uh, I would be a bit wary of putting my money into an M&M. Ranbaxy, the news flow on Ranbaxy is bit of negative. I would be in a, I would just wait for the dust to settle down, and probably then we can revisit the question of whether we should invest into Ranbaxy or not. So among the three stocks mentioned, I think we can look into M&M over next 5 years as a horizon. The fact that auto is not doing well is a very good sign, because then we can, if the M&M there is good likelihood of M&M to correct. If that were to happen, then we can get it at a very good price, and we can make real money out of it. Uh, the next question is by Mr. Rajiv Kalya. His question is very genuine, and we also have been looking into this. His question is, why in many cases stock prices go way lower than discount prices? Why no mechanism of timely info to cut losses and invest lower? See, sir, the problem is it's very hard to understand how irrational at times the market can get. If I were to take you through just one company like NMDC, it has fallen by uh, about a 20 to 5 to 30 percentage below its DP 179. Yeah, it has fallen. So I just take you through one analysis that we have been doing, and which I would put out as note probably by Monday. But I will take you through my thought process. I hope you can see this graph. Now, what I've done is I've tried to see at what is the cost of operations for, say, BHP Billiton, a very large iron ore producer. He commands about 28% of iron ore market. Okay, and at what is his typically realized price for iron ore? The blue bars are what are the price at which he sells his iron ore, and the red bars are at what price is cost of operation for iron ore. So for if you look at BHP Billiton, he price for and mining iron ore is about $47.1. His cost price for his selling price for iron ore is about $110.99. And this way I've done it for the three large iron ore players. Uh, I've done it for BHP Billiton, Rio Tinto, and Vale. And here we have NMDC. Now, what we have tried to do is we are trying to see, let us see a hypothetical case of what the share price of a NMDC would be if it were, if the iron ore market itself were to go through a very extremely bad scenario. Like, let's take a case for number one, like BHP Billiton, which has a higher cost of operations than the other two, Rio Tinto and Whale. If it were to start making losses, the iron ore prices were to fall down so low that BHP Billiton is making just earning whatever is its cost of operations, but cannot pay off its interest, cannot pay off its tax, cannot pay off its depreciation or and so on other cost. If that were to be the case for an iron ore market, as in the 28% of the market itself were to go out of business, then the price indicative price of NMDC should be somewhere near to 91 rupees. Same way, when I were to take both, let's say not just BHP Billiton, both Rio Tinto as well as BHP Billiton, both of them are making losses. Then the pricing of NMDC as a share price should come somewhere near to 81 rupees. And if let's say all the three as in who command the 70% of iron ore market were to start making losses, then NMDC's best case, worst case price at that kind should be in 80 rupees as such. Even after doing such extreme case analysis, if you see the current market price of NMDC is about 117, which is not very far off from what it is. So what I'm trying to say over here is that while there may be a limited downside for NMDC as such, but it's very hard to tell what the downside would be. What we are sure is that theoretically speaking, NMDC going below 80 is a case wherein most of the big iron ore players as such are making losses. As in, we are looking at a situation in which the humanity itself is saying, boss, we do not need iron ore as such. Only in that kind of case can we think of an NMDC coming down to an 80 rupees. Now, when we think that there's so huge a gap in between a extremely negative scenario and a DP price, we do not know how irrational market can get, and because of that reason, we are developing, we are looking at some other ways in which we can identify if there is some negative, some signal that we can look into, some technical method that we can look into to identify a low bottom. But to say that we will be successful 100% of the time or even decently successful is something very hard to call to take. But what we do look out is that whenever we give out a buy signal, we believe at the very fundamental core level that over a long term these companies will do really well. Do we believe that there might not be a short term pain? No, probably there can be a short term pain. Probably the prices can correct 25 to 30 percentage from our buy signal, but what we do believe clearly is that over long term these companies should do extremely well. So the other thing that, as I had explained before, we are also trying to set the expectations of our investors right. Just because it is, let's say, near to its GP does not necessarily mean that you should put the whole of your 100% portfolio into NMDC, because at the end of the day it's a cyclical business. So that's why you are going with that postage tagging way. So when you see once you take through our risk profiling, you would be given a standardized enough portfolio metric breakup in which we would tell you that how much you should look at ideally to put into cyclical, how much to look into to put into value, how much to put into stalwarts. And once we structure it around that, then I think we can address this concern of yours much better. The next question is by Mr. M.R. Balaji. How to select multi-bagger stocks waiting for a period 5 and above? Uh, Mr. Balaji, to be very frank, most there are two types of multi-bagger stocks. One are companies like NMDCs who are going through a very tough time. Now, these companies within NMDC, type of companies within NMDC themselves can be of two types. One who do not have balance sheet stress like NMDC. The others are who have balance sheet stress like Tata Steel. Now, both of these would come with different kinds of risks. While one risk would be common to them that the business cycle itself will not do well, but the other risk that the balance sheet itself is stressed and so on, the company itself can go default and go bankrupt is very high with a highly leveraged company like Tata Steel. So while both of these can be good multi-baggers over long term, what you need to aware of is that when we say about multiples for such large company, we are speaking about not more than three times or four times. We are not looking at a very large multi-bagger company. The other type of companies are typically wherein you are looking at a very strong return over next 5 6 years. These would be typically be red companies, and that is why to identify such kind of companies who are either turnaround cases or who are cases wherein the companies are very small as of today but expected to become huge companies into future. These kind of in these kind of cases a huge amount of analysis has to be go through. The metrics that you see on our site are not geared easily to help you out with multi-baggers, but what you can really do it, uh, leverage our site is, y- we regularly come out with analyst notes, and going through those analyst notes with some companies may help you out pick very good multi-baggers. For example, let's look at one company, Engineers India Limited. Now if you see Engineers India Limited, it's at a very low price, but we do believe that it can be multi-bagger over next 5 6 years. And typically an analyst will have a note on the company, and these kind of notes can give you a very good indicator of how the company can really do. I'll take you through one more example. Let's look at Hindustan Zinc. While not truly a multi-bagger possibility, largely because of it can get delisted and get adopted by get into the fold of Sesago and Sterlite as such, become 100% subsidiary of them. But if it were not to happen as a subsidiary, then we really believe that as Hindustan Zinc can be one of the multi-baggers as such. And if you go through such notes that we put out regularly on our stocks, you would see that it's a very in-depth analysis done by our analyst, and that can really help you understand whether this company, while it might not show through our preferred way of it being a green company, be available at a substantial discount and it really do well uh, uh, in the past. But these kind of notes can really point out to you to companies that can be multi-baggers or can do extremely well over in a short term. We try to have it a mixed bag, have show you companies that can be give you good returns over some short term period because of some fundamental change that is happening, and so point out companies that can be become a multi-baggers over a bit longer term. On the other hand, we also point out the other type of the companies, also companies which are going through a very risky phases. They can give you short-term pain, or are, while they may have made sense over the past, but probably in future they are not looking so good. So all these kind of extreme cases are taken care of within the analyst notes. So I would suggest my clients, my friends to go through these analyst notes so that they can make a much better decision about the companies. Uh, The next question is by Mr. Thomas Varghese is, how can I choose a winning stock? Mr. Varghese, in most of the webinars that we have been conducting, and we regularly conduct webinar on how to select safe and strong stocks, uh, we take this question in a much more detail, but I would answer you this question in a brief way. The core fundamental basis through which you would like to select a good stock is by answering three questions. You should first identify a right company. A right company is a company that has a very good management, has a very good growth prospects. It has done extremely good in the past 10 years and likely to do so well. This can be easily be identified by the first block that you would see in the decision maker. That is sorry, that tries to identify by right stock by telling whether the company was has good history in the over 10 years, what are its long term prospects. So once we have answered this question, the next thing is at what price is it available. Typically I would like you to look at a company that is available at a good discount to DP price, or somewhere in between MRP and DP if it is a very very good company. Once we have the understand the valuation of the companies, then the third question would really be whether now the time has come to buy this company or not. Once we have answered all these three questions, I think that is a good way for looking at and picking up a winning company. The next question is by Mr. Prashant Kadam. His question is, which would be better over long term investment, NMDC or Sesago? Okay, sir, this is extremely hard question for me to answer. Uh, Both these companies can do very well, but for extremely different reasons. Why Sesagoa will do largely well because of the fact that we believe that Sesagoa after its merger with Sterlite can really get re-rated upwards, because it would not be dependent on a single ore, on a single metal, as you would all be aware of that last year had been a very bad year for Sesagoa, largely because both of its operations in Karnataka and Goa had to face mining ban. This was a flat ban on all of the, mining companies in these areas, not just Sesagoa specifically, but it had really impacted Sesagoa's revenues and profit as such. Now, once it were to merge with Sesa, and when once it Sesa and Sterlite were to merge, it would not just be dependent on iron ore. It would have uh, some part of its revenue coming from zinc, some part from lead, some from part from silver, some part from copper. So it would be a diversified portfolio business, and we typically globally, uh, whenever we see a case wherein not all the commodities are rising at the same time, when sometimes zinc is doing better than iron ore, sometimes iron ore is doing better than aluminum. We see that companies who have a diversified portfolio do extremely well compared to companies who have portfolio of an businesses which is dependent on a one or two strong and one or two strong metal and segments. So even if you were to see globally, BHP Billiton, which has a much more diversified portfolio and it, trades at a substantial premium to Rio Tinto, which is largely dependent on an iron ore to earn its iron ore, and to some extent copper to earn its profits and revenues. So this is the case for Sesagoa. Uh, another NMDC, as I have already told, we believe that while on the unlike Sesagoa, it would continue to uh, be dependent on iron ore as such, but it is trading at a such a very irrational price that we believe that NMDC would do extremely well. I'll just give one more metric for you to look at NMDC. NMDC over last 1 year had declared a dividend of 7 rupees as such. So you would have earned 7 rupees on dividend. Now this translate now current closing price of NMDC is about 117. Now, if I were to divide 7 by 117, I would get somewhere around 6 percentage. So 6 percentage is flat dividend that you are getting when you are investing into NMDC. This is very good because if you were to remember, if you were to invest money into FD, you would get somewhere around 8%, and that it would get taxed at somewhere in between 20 to 30%, which would take your interest earning from FD itself to be somewhere close to 6.5 to 7 percentage. Now, if you take that into fact, if NMDC were to fall any further, I am personally speaking, I would be putting more money into NMDC as such. So both have two different kinds of risk profile. I personally have some amount of my, when I am looking at and having some amount of exposure to metal segment, I am looking at having both CESA and NMDC in my portfolio. But what I'm trying to look at is that the metal sector as such will not have more than 15 to 20 percentage within my portfolio, and as it is a cyclical company, these are all cyclical industries. So metals, capital goods, autos, these together would, which are identified clearly as cyclical companies, would not have more than 15 to 20 percentage together. Once I put that discipline into place, it I would look at having both NMDC and Sesagoa into my portfolio, because if I don't know where not to do well, Sesagoa would end up getting benefit because it has a diversified portfolio. On the other hand, given the fact that Sesagoa still has to go through a lots of corporate actions, one, Sesagoa needs to get merged with Sterlite very well soon, as a, declared by the management last year. It's long overdue. Two, Hindustan Zinc and Balco has to become 100% subsidiary of Sesagoa. That would really elevate its problem with other and one of its other and subsidiary. Other likely subsidiary, that is Vedanta Aluminium. And three, we would also like that sometime in future its investment into cane can either be monetized, or cane investment itself can be raised to such a level that and a cane can become a good large subsidiary of Sesago as such. Once these two three actions, especially the merger of Hindustan Zinc and Balco into Sesago Sterlite takes place, I think Sesago is up for prime for another re-rating. So I would like to have both of these into my portfolio. But given a choice, if I am risk averse, I'd go with NMDC. If I am a bit more risky person, I would have bit of exposure. I would have exposure to Sesago over NMDC. Okay, the next question is by Mr. K.S. Sabrawal. His question is, even market crash, your selected stocks never come to ideal price. So how we are benefit with the rise in price? Uh, Mr. Sabrawal, firstly, I would like to point to that a 2 percentage or 1 percentage fall in market is not really a crash. A market crash would be something that you see a 15%, 20% and a correction into market. Having understood, I understand from what place you are coming in. I Let me take a company that probably would satisfy what you are trying at. Is if you look at uh, Asian Paints, it is something like this type of company in which even if market has today corrected by 2%, Asian Paints might not have corrected largely, or it may be some, even if in the worst case its DP might not get hit. So let us look at its price chart. In the price chart, uh, wait a second. Uh, I, I think I'll show you through IT. Price chart has not updated. Let me see. Yeah. Now, if you see price chart, what you would see is that there is a buy sell plan that has been created for companies like Asian Paints. We are following this from a dictum of one of the famous sayings of Warren Buffett, wherein said that at times it may make sense to buy a very good company at a fair value compared to buying a fair company at a very good discount. So following that, thinking itself, what we are saying is that while as accepting that my MRP is 4671 and my DP is 3737, if I would still start and making my investment once it were to fall a bit below DP, let's say if it were to fall to 4297, I would ask you that if you have decided to invest 1 lakh into NMDC, let us put 5000. If it were to move a bit more ahead, let us see about 4157, I would say that 5% we have invested, let us put up to 15%, meaning let us put another 10,000 money into it. So as the prices go down for a company like NMDC, which we believe is company like Asian Paints, which we believe is a very good business, very strong brand business, companies that we believe are extremely well rated businesses, these kind of companies we would try and give you we try and suggest our clients to start investing as per this buy sell plan. If the whole of the buy sell plan were to go, our simulation shows that your average price should be a bit 2 to 3, just be 2 to 3 percentage above DP, if the price were to move from MRP to DP completely. So while we'll start the get the benefit of the fact that the Asian Paints is falling and it's trying to reach towards its DP, but if it were not to happen, at least a substantial portion of our investment would have happened even if the price were to correct by 5 to 10 percentage from our MRP. So that can be used as a this mechanism has been created so that we do not miss out on opportunities of buying into a fairly valued company with a very strong business model. I would request you to just go through this buy sell plan. If you have any doubts, just let us know, and we will be happy to clear you on call or through our customer care. And just go through this buy sell plan, just experiment through this buy sell plan. We believe that buy sell plan is really an answer for investing into companies like Asian Paints, ITC, these kind of companies which are very good in a business portfolio, which have done extremely well in the past and which have very good in long term prospects also, but are trading near to a fair value. And given the size of their business, their ability and their management capability, their business, their brands that they have, it's very, unless and until it goes through a very crisis scenario, the DP might not be hit. So for these kind of companies, we are coming with a new plan, and that plan should help you out into investing into this kind of company. The next question is by Mr. MG uh, Kalyavanan. His question is, when we get buy and sell signal. Uh, okay, now how there are two methods through which buy and sell, three methods through which we generate buy and sell signals. All three methods are interrelated to each other. One is, if the company is like Asian Paints, we have a buy sell plan through which a buy and sell signal comes in. The buy sell plan tries and uh, put a discipline within us so that we start investing into a very good company as and it is available just below its MRP prices, so that we do not become too greedy and start waiting for out for its DP. So these are the companies that have covered well through the buy sell plan. Then there are companies that in which once the DP has been hit, there are some technical uh, uh, patterns that we are looking into to identify if there is a turn, if there is a shift that is going to take place. So those are handled through technical things. But much more below that, at times prices like for companies like BHEL and NMDC, we have seen that even the technical signals have not done well. Here over here, it is the analyst who takes over everything, and he starts giving out buy sell calls across based on his judgment. Now this system has been placed since today, and because of this reason, if you were to look into, say, top 200 superstar, let us see, if you have to look at time to buy, uh, if you have to look at time to buy, you would see that at least four to five companies, all of them have come at buy signal. Now majority of these companies have been in a have come out because of analyst expectations on these companies, and we believe that these companies would do extremely well into future. Now this is how we give buy sell plan. We look into all the three ways. One is we try and inculcate a discipline. This has become largely because of our learnings from behavioral finance. Two, we are also trying to see, okay, I have done fundamental analysis. Is technicals telling me something because of which I should try and make an investment or make my sell decision? So the second is my technical logic that takes over. And third, we as analysts ourselves may have certain expectations from the company, and on those basis also buy and sell signals are generated. So all the three methods are used to give out buy and sell signal. The next question is by Mr. Ravi Arora. His question is regarding Suzlon. Uh, Let us go through Suzlon first. Now, as you understand Suzlon, now there was a question about multi-bagger. Now Suzlon can be one of the companies that can be a multi-bagger. Now if you see, even though we identify this company as not good, largely because of the fact that it has taken a huge amount of debt, it's an ROCE has fallen down, the value creation has not been very good since 2008. And if you remember, it was in 2007 when Anna Suzlon went ahead and bought uh, Repower, which has been largely been responsible for this mishap. Now, what we are suggesting people when they look into Suzlon is that, yeah, we understand how that Suzlon is coming through a painful restructuring process. Uh, Let us go through that restructuring process. Let us see that it if nothing, at least it is capable enough to service its debt. Let us see that its order inflows are well, which it is, which we see that is happening. So as of now, what we would like to see is that let's see that at least it's let's see some one or two few quarters when it's at least its operating profit margins becomes better, and then we can look into and buying into Suzlon. And because of this reason, we price it at DP at a 8 and MRP of 29. So if you see a margin of safety for Suzlon is extremely large. The only thing I would caution you against is not to put a very large amount of your portfolio into Suzlon. Probably not even more than 3 to 4% of your portfolio should go into Suzlon Energy as such, because if it does really well, it can become a multi-bagger of 4 to 5 times or even much more bigger, and that would give a large chunk to your large return to your portfolio. But if it were not to do well, we can it we need to accept that Suzlon is also staring into a possibility of filing for a bankruptcy because of the fact that it has a huge debt position which is becoming nearly unmanageable of sorts. So if CTR works very well, Suzlon can become a multi-bagger. If CTR does not works, as in corporate debt restructuring does not works for Suzlon, Suzlon is staying at a very deep abysses. So I would request that you do not put more than 3 to 4% of your portfolio into Suzlon. But if Suzlon were to come down to somewhere around 8 to 9 rupees, yes, Suzlon may make a very good investment worthy case. But just be cautious, and when while investing into companies like Suzlon, we need to track the news flow also, so that if things have gone bad, we can exit Suzlon immediately. The next question is back, Mr. Nasim Rao. What sectors are best to invest in current market conditions? In current market conditions, I typically tend to look out for two types of sectors, and I diversify my portfolio across these two sectors. One is banking. Uh, well, typically what we have seen is that the moment the markets tend to move from a bear phase to bull phase, the first thing that starts happening is the investments of core sector companies starts picking up. And when that happens, it is the banking that really does well, because the banking is the one industry that is going to finance a core sector industry expansion. And because of that, we see that immediately we see a jump in the revenues, in the income earned by banks, in the fee income earned by banks, in the interest income earned by banks. We also see a write back of certain provisions that have been done in the when a beer time. Certain we also try and we see that some loans that have become bad in the recessionary scenario now become good things. Let's take case of Suzlon itself. If SBI would have lent to Suzlon and things were to look really well for Suzlon, Suzlon will also start paying back those loans to SBI. Now SBI may have written off some of that loan off, but now it will write back because it will realize that the loan that it had written off from its books is something that it can get back from Suzlon. So it would again give a very large profit and cash flow to SBI. And because of these reasons, we I typically prefer banks in this kind of economic scenario. Uh, Having said that, if the things were not to go well, if the things were too off from the economy, I balance my portfolio by investing into some value companies like NMDC, MOIL, Ashana Housing Limited. These are some very good value companies across all type of mid cap, small cap, large cap that I invest into. Uh, this and I, if I invest into a value company at a very good price, it gives a good anchor to my portfolio. And if the economy were to really do well and the stocks were to get re-rated, then the value would do extremely well than my banking investment. But having said that, this is a question that is very subjective. It is subjective to the fact that how your risk nature is. By my nature is a very extremely risk taking person, so I go by this way. But if you are a risk averse person, I would rather suggest that instead of putting it into metals or mining type of a company, you can have a split of your portfolio in between banking and to some extent in between, and as let's say FMCG and IT company as such. But within IT, I would tend to avoid Infi for some time, but I would really look into some mid cap IT companies. They are expected to do much better than another large cap companies. HCL, while large cap company, would do well on a business level basis, but we believe the valuation of HCL is a bit overstretched. The story is a bit overstretched now. So unless HCL were to correct, I would not be looking at HCL as a large cap company. But there are very good opportunities within IT industry at a mid cap level. We are doing really good work, and these are the companies that I would really look at adding into. One of the companies, if I were to just mention, I just from the top of the mind, I'm not very clear how the uh, valuation would be. Is Info Edge? Okay, now this is a company that is very close to MRP. Now, if Info Edge were to correct, even let's say not back to its DP, but even if it were to correct to let's say somewhere around 280 or 260 odd levels, I would really look at Info Edge to be a part of my portfolio, because Naukri.com, which is the Info Edge company, would do extremely well once the employment level picks up. So these are the type of companies who have a niche, companies who have a real business and a strong business model are the companies that I would look into my portfolio in these kind of scenarios. The next question is by Mr. Sushil Chandar. His question is Maharashtra Seamless EIL BHL. Shall we stay, investor, exit, or add more? If Maharashtra Seamless as of now has not become about 5 to 10 percentage of your portfolio, you can still consider adding into Maharashtra Seamless. But if you have added that much, I would rather suggest let's not invest into Maharashtra Seamless. There are better opportunities like NMDC, MOL, that give a similar exposure in which we can look invest into. But if Maharashtra Seamless has still a very small part of your portfolio, yes, you can definitely look into adding into Maharashtra Seamless into your portfolio. Rather, now I have become more bullish on Maharashtra Seamless, and one simple reason for that is those of you who have been attending this webinar for some time, I been consistent in this, that the one thing that I would like to look out is whether US would allow export of natural gas or not. Now, over last 1 week, Obama administration itself has come out with a policy in which they are going to allow natural gas exports by natural gas companies in US. This is a very good, very big jump, very important point for Maharashtra Seamless, because seamless pipes that Maharashtra Seamless makes are pipes that go into transportation of oil and gas and natural oil and natural gas. Now, this industry, the largest piping business happens in US and Europe. Now, because of the shale gas glut that had happened in US, the price by shale gas glut, what I mean is a large amount of shale gas was being produced in US, but because American companies cannot export it, the shale gas prices had fallen down from $4 to $2, and because of that reason, many of the companies who were trying to build pipeline projects, large pipeline projects, large shale gas projects, they had to shelve their projects. They had to put their projects on hold, and this had impacted negatively into piping businesses. Now that the Obama administration has taken decision to allow shale gas exports, we believe that because of this, the shale gas pricing would be much better. It would be north of $4. We are already seen initial indication of it. We are already seeing that the natural gas prices in some states like California and in New York is already stretching towards $4 to $5. Uh, Now that this has happened, we believe that the projects can again kickstart, and this would mean that order inflows 1 year hence for companies like Maharashtra Seamless will be extremely good. Coming to your case for EIL, you can again same way you can look into EIL if EIL has not become something around 10 to 15 percentage of your portfolio. EIL is an extremely good stock. The only point of caution is a large chunk of the EIL revenue growth will come mostly in period of 2015 to 17. See, this is a company which gets huge amount of its order largely from oil marketing companies like HPCL, BPCL, IOCL, and ONGC. It also at times gets its orders from fertilizer companies also, and at times also from global companies. But much larger chunk, comes from the Indian oil marketing companies, uh, even sometimes from private sectors like SR Oil and uh, uh, MRPL and then Reliance. Some you get orders. EI gets its order from this. Now, because a large chunk comes from oil marketing companies, what typically happens is whatever is laid out as oil production capacity or oil projects for the next 5-year plan, these oil projects, refinery projects, are planned over an initial 2 to 3 years, and only after that the real and orders and uh, purchase orders are issued by these oil marketing companies for for companies like EIL. So major part of the revenue jump will come in 2015 to 17, and if you have the staying power for that time, if you are okay with the stock not performing well for next 2 to 3 years, then EL is company that you can really look into. I do not foresee a much downside below 150, 145 levels, but if EIL were to fall down from what it is currently trading at, I would really add EI, company like Engineers India Limited, which has no debt, extremely very good cash position into my portfolio. So it is trading somewhere around 161. If let's say because of the weak market condition, if it were to trade come down to 145 to 150, I would be extremely happy adding EL into my portfolio. Uh, The next question is by Mr. Ashish K. His question is about on Compton Greaves and Maharashtra Seamless. I hope Ashish, I have answered your question on Maharashtra Seamless. Coming to Crompton Greaves, the one thing that most people forget is Crompton earns a huge amount of its revenues from Europe. So if you want a single pointer of when you should start adding money to Crompton Greaves, you should just need to keep an eye out for Europe getting a bit of a stabilized. Once you see that the finance ministers of Europe are not meeting each week or each month to sort out the mess that they have created in Europe, once you see that the Draghi is not coming on the news, this is a good indication that the European markets are now doing well. European as an economy is now doing well now because Crompton Greaves gets substantial part of its revenue from Europe, and if once Europe stabilizes, I think Crompton Greaves can make a much better sense then rather than now. So I would not try to and invest much money into Crompton Greaves now. Even if you have invested, if you have invested at let's say somewhere in between 120 130 rupees, I would rather stay invested into it unless situation in Europe deteriorates extremely bad. I would stay invested into Crompton Greaves, but I would not add to my positions on Crompton Greaves either. Uh, the next question is from Avinash. His question is from when we will be getting the buy and sell signals for top 100 superstar. It's too long now. For last month, we are not getting signals. We are losing a hell lot of opportunities in the market. Tell exactly when it will be resolved. Mr. Avinash, as you would be aware that we are a long-term focused company. Unless and until we see that there are good investment opportunities into uh, investing into a company over longer term, we generally do not release buy sell signals. But now if you would have seen that over last 2 3 days, lots of buy sell signals would have started coming in. As the market is correcting, you would see a lot of companies that would start hitting our price, because we tend to follow contrary to what market follows. We try and tell our investors to invest when the market is falling and try and exit, try and sell when the market is becoming greedy, and we can then book our profits at a much more higher price. So if you see, uh, you should see, I suppose, all the four companies coming into your buy signal as of now. All the four companies are top companies. These all should be getting reflected. We believe if market were to correct another 4 5%, I believe another few more companies can get added. Of the hand, I can tell that you can even look into EIL to add into your buy list. You can even look into adding MOL to into your buy list. These are the companies that are very close to its DP or below DP. These are companies that you can look into adding into your portfolio if you have not added as of now. The next question is by Mr. Raman Vardarajan. His question is interest rate sensitives and oil sectors are likely to do well. My assumption, please confirm. Yes, there is a good, this is a good hypothesis to assume that interest rate sensitive and oil and gas can do really well. The only point of caution that I would like to add to you is that to large factor this has been already been factored into by the market. So at many places you would find that interest rate sensitives like banks have already done extremely well compared to the overall market. So uh, unless and until we are looking at RBI cutting down interest rates by another 1% or so, the banks might not do extremely well. They may do well, but not extremely well. On the other hand, these we need to remember that we are entering into an election year. Let us see whether the government has a discipline to allow oil and gas companies to continue to raise prices in India. And they can reduce their under recoveries, they can increase their profits. If that were to happen, then oil and gas companies, especially IOCL, HPCL and BPCL, would do extremely well. But speaking of oil and gas, Oil India and ONGC should do well, because over last few days we have come across news that which results that leads for us to build an expectation that the subsidy burden on both Oil India and ONGC will be much lesser than what they had seen in the past. Let's have a look. Sorry, let's have a look at within all stocks at oil and natural gas. So if you see, uh, even though it's not near to our DP, it's not very substantially far away from our DP. Also, it's just 15-20% away from its DP. If we were to see some market correction and it were to come down close to even DP, then yes, ONGC is one company that I would really look into to put in my money into within the oil and gas sector. Same way, I would also look into Oil India. Same way, while it is substantially a bit far away from my ON compared to ONGC, but even if it were to come down to 500 number like 500, I would really look into buying into Oil India. So these two would do extremely well. I'm a bit skeptical on the oil marketing companies like HPCL, BPCL, but more positive on the banking side. Your assumption is correct. Oil companies like ONGC and Oil India and interest rate sensitive companies should do really well. Yeah, we are recommended a buy on PNB. What we are looking at is that you need to be invested for at least 2.5 years as far as PNB is concerned. Unless and until the price were to rise too high and we were to issue a sell signal, then I would just request you to be associated with PNB for some time. Can I buy Kane India? This is a question by Karamjit Singh. Yeah, you can look into buying into Kane India, but if you're planning to buy Kane India, let's say put about a lakh in Kane India, I would not suggest you to put the whole of soul money. It is below its DP price, as far as I remember. It's below its DP price or would just be close by. Yeah, it's below its DP price. You can look into. The only thing I would like to caution into, and it's not a caution as such, it's just an opportunity that we can get. Oil prices themselves are expected to correct by some 10-15%. If in the recovery of Japan and US were not to be very strong, the oil prices themselves can correct a bit, and because of that reason I would like to take that opportunity to buy cane at a much more lower price than that, because that means if oil prices were to correct by 10-15%, it would mean that cane would also correct by similar levels by 15-20%. And if that were to happen, I would like to get into that opportunity. So but I'm not sure whether it would actually happen or not, and in order to be greedy towards getting it at somewhere like 240 to 50 levels, I would suggest that let us start investing some amount out of 1 lakh that you are planning. Let us invest at least 15-20,000 at 285, another 25,000 somewhere around 270 or so levels, and the rest somewhere around 240 to 250 levels. So that would ensure that even if the oil price is correct, then we would get the benefit out of it and we would make substantial returns over a longer term. one question is by Mr. Amit Randive. His question is, how can we backtest the returns on any company on your website? Sir, if you were to look into any company for your website, we are the only exception in the industry. You can actually check out how our MRP and DP has moved out. Let me tell you, show you a company like Reliance Infra. Even though it is a red company, I would like to show you something. Let's have a look at its chart. Now, if you were to look at it at 3 years, you would see that Reliance Infra, even though it's a red company, it was trading in between my MRP and DP. And this is not an exception. We give the whole history of how our performance has been. I'll take you through three, four more companies. Let's look into Hindustan Zinc also. Now, if you look at Hindustan Zinc also, it has been trading in the range in between our MRP and DP. Uh, it hit our MRP and then it reached our DP, and again we expect that it should move again from the DP hit to an MRP. Another company that we would like you to look at is, let's say, have a look at Grasim. So what I'm trying to point out is that uh, you can really go and check what our MRP and DP has been for each and every company over historically, and you can see whether then our performance has been good or not for the company as such. If you were to look at Grasim, it's a very interesting chart. You see that now we substantially increased our MRP and DP such that uh, what was our past MRP had become our DP, and what was our new MRP is way above our its DP. If you were to look into this, you would see that it was below its MRP sometime around June 06, and then it had reached quite high point of our about 377, nearly 3422, that is about 7 to 8 just 8 percentage away from its MRP. So this itself would have meant that over this short span of time you would have made about 70% return. Even if you have not done it that way, let's say you are still would have kept invested into, you would have seen that as of now you would be somewhere close to, let's see, uh, uh, you would still be close to about 10 or 20 percentage in profit as of now, even if you would not have sold it at a peak price. So what I'm trying to say is that for each of the stocks that are covered by us, you would definitely see what our past historical guidance have been. And while I do not say that we will be right each of the time, but what we strive to maintain is that we would try want to be in a correct at least on a 50 to 60 percentage of time. And if let's say 10 to 15% of time it does not works out, and probably another 10-15% of time when we are a bit wrong, that is a record that we would like to maintain on our site. That is what the type of returns that we would like to give to our investor, that on 70% of time would like to be extremely be correct. The next question is by Mr. Kamalkar Chaudhary. His question is it a good strategy to buy even growth stocks at price below DP price? They may not come to DP level also. I would beg to differ with you, Mr. Chaudhary, that growth stocks might not come to an DP price. What we have unfortunately seen is many of the growth stocks, like even the companies like Jubilant Foodworks, they in pursuit of growth they try and commit some basic mistakes like over extending their balance sheets to having operational weaknesses come into their business models in pursuit of growth. Three, what we see is that the incremental economies do not make real sense as far as the business is concerned. And because of this reason, we believe that even growth stocks can come into DP. Might not be immediately when they are when they are captured the glamour, or so to speak, of about the markets, but surely they would also get corrected. Uh, Not long ago, we Infosys was a growth story, but it has corrected to its DP. So it's not that the growth companies will not correct to its DP. And once the economy shifts its gears for that particular industry, you would rather see that the growth company would correct to its DP at much more faster level than even than compared to its stalwarts or other type of companies. पुराने गाने का- uh, the The next question is presently how many companies are there in buy sell plan? Presently, only greenest of green companies are covered under buy sell plans. So under aggressive buy sell plan, we cover about 7 companies. About in moderate buy sell plan, we are covering about another 15-20 companies. So that is the range of companies that we are covering into. Most of these buy sell plans will get activated by Monday. So the whole of the buy sell plan would be about 25 to 30 odd companies. Thank you, friends, for joining us for this special subscriber webinar. If because of the paucity of time, I sorry if I could not have taken any more further questions. But if there are some questions that have not been left unanswered, please drop them to our customer care. We would proactively try and get back to you. And answer them to the fullest of and so that you can make better investment decisions. It was great to have you all over here, and with this, I would like to bring the meeting to the end. Thank you very much. We would appreciate if you can give any feedback either on the meeting or on the site through the chat window or through the survey to which you would get to once you exit the webinar. Thank you very much for joining us.